Start recording. Okay. So today's agenda for the class is we'll be covering O2C cycle, which is also called as O2C in short term as order to cash cycle. So then we'll be looking into the overview of accounts receivables, the key flex fields in accounts receivables, the receivables accounting event model. Then we'll go into auto accounting structure, then invoices with accounting rules and the statement cycles. Okay, so this will be our today's agenda. All right, so let's get to what order to cash cycle is. I'm audible, right? Yeah.
Yes, ma'am.
Okay, okay. So order to cash also, as I just mentioned, known as O2C, refers to the set of business processes for receiving and processing customer sales orders for goods and services and their payments. Okay, so that's a basic
Okay.
what O2C means. So these processes are at the heart of all businesses, and unless they are managed efficiently and accurately, organizations would not only face financial problems but also reputational issues, right? So every department in a given company is affected either directly or indirectly by the order to cash system. So now let's look into the steps of the order to cash cycle. See here, the first the cycle begins with the system receiving orders from the customers. This could be either via email or internet, salesperson, or through your fax. Okay, so in some businesses the order could be a simple purchase request for a particular product, while in other service oriented or wholesale businesses the customer and the company would enter into a long term or a short term contract. Okay, that's where your order management happens. Then the company might even conduct a credit review, okay, of the customer before accepting the order. So what is a credit review? What do you mean by credit review, Durai? The basic idea of
Credit
credit
limit,
yeah.
particular credit limit
That is
for that
limit.
customer.
I'm saying review. Limit is okay. Limit is, see, you come to a credit limit only after a credit review, right?
Okay.
So what do you mean by a credit review?
Uh, in individuals financial profile has
Yeah, so you basically in credit review, what you do is you check the credit worthiness of a person. Yeah, that's the word.
okay.
It's you have to check the credit worthiness of a person or of a company. It's a check to
Okay.
see whether the party is suitable to receive financial credit. Okay,
Okay.
so it is often based on their reliability in paying money back, in the past, whether how they're like, in this in banks, when people apply for personal loans or home loans or whatever,
Hmm.
they have this CIBIL rating. It's
Yes,
basically a
yes.
credit rating. Yeah, so that is your credit review. So there are a few organizations who are into credit ratings given to the companies, like your tier A companies. How do they divide those companies into tier A, tier B? So all these factors also come into the picture. So one of the factors into categorizing those companies are credit review, right?
Okay. Okay.
Okay. So
Hmm.
then especially if they companies, if they have plans of offering the customer a deferred payment meaning postponement of repayment. So then in that stage also they need to do a credit review. Only with the help of that credit review they will come to know the credit worthiness of that particular customer. Okay,
Yes.
then the order is documented. Okay, once all these checks are done, okay, the
Okay.
order gets documented and the company begins in the task of fulfilling the order. Okay, that is your third stage. Then once a product has been shipped and delivered or the service has been fulfilled, the most
Okay.
important stage of the cycle begins with regards to cash management. Okay, the
Okay.
invoice, see, order is fulfilled, then it goes to shipping and transportation, and then the invoice is created and sent to the customer for payment. So after the customer has made the payment, the accountants, note the entry in the general ledger, and all the data are then used for report generation for a better decision making. So basically, once invoices are sent, then it's been received in your accounts receivable. Then the collections departments get it collected. Okay, then final reporting happens where it helps the company also for their further plan for their future plans. Okay, so this is a
Okay,
basic
okay,
idea of how the order to cash life cycle runs. Okay, all right.
okay,
So we'll move to the next one. Now let us have a look into the overview of accounts receivables. Okay. So Oracle Fusion Receivables provides integrated functionality to perform most of the day-to-day accounts receivables operations. Right. So these are the day-to-day accounts receivables operations which happen in the accounts receivables module, or even the department is
uh-huh.
also usually different, right? So receivables functionality is managed via three overview work areas, which are the billing, okay,
Okay,
billing, and then the receivable
mm,
balances, and then the revenue management, which happens here. Okay, so
okay,
now see, all three work areas provide access to general ledger account activities. So including
okay,
creating accounting, like creating manual journals,
mm,
okay, or and receiving journal entries and all that, your basic account activities under receivables. Okay, now let us understand briefly about all these three work areas. So now billing work area, what do you do under that? See, billing work area helps to perform tasks related to customer billing activities. Okay, so you create, you process, you present and process the billing adjustments. Okay, so you monitor
okay,
and review incomplete transactions and approve pending adjustments. You use auto invoice to import transactions from other systems and generate invoices and credit memos automatically according to your requirements. You can easily review and correct auto invoice import errors also, and resubmit auto invoice. Then you create new invoices, debit memos and credit memos. You can also create a new customer record and manage existing customers from the billing work area. So that all happens in this, right?
okay,
Then you have the receivables balances work area. Okay, so you use the receivable balances work area to perform tasks related to customer payment activities. Okay, and the
okay,
management of accounts receivables balances here. So you
okay,
review actionable items including open receipts. Okay, and
okay,
then like open receipts and receipt batches, credit memos, receipt remittances, and fund transfer errors. So you create receipts manually, either you import receipts via lockbox and spreadsheet, or create automatic receipts. Okay, so you perform related activities to manage your receipts, basically apply and apply, you reverse it or you delete it, right? So
okay,
you create even adjustments or chargebacks during your receipt applications and remit here, and all those receipts which wherein your adjustments are required, right? So you do all that in under this receivable balances work area. So you can also perform tasks related to managing account receivables balances, including receivables and balancing receivables accounting period statuses. Okay, that you'll understand when we take you through that invoice creation. You'll
okay,
At that time I'll mention about how the receivable balances work. Okay, so these are basically the work areas under the receivables accounts receivables, as I mentioned. Yeah.
okay,
So
okay,
then we have the revenue management work area. So here what we
mm,
do is we use the revenue management work area to perform tasks related to revenue recognition and revenue adjustments. Can you
okay.
tell me what is the difference between a receivable and revenue?
Uh, revenue is an income.
Okay. Income of what?
Income of
Okay, then what is receivable? Okay, revenue is income, you said. What is receivable?
yeah, it can be. Yeah, it is a money received by a company or a government like that.
What is that, revenue or a receivable?
Revenue.
Revenue. And what is receivable?
Um,
Excuse me. Okay. See, a receivable is nothing but the amount.
Able to be received.
What did you say? What did you just
You
say?
you asked just what is
No,
receivable
no,
or
yeah. What is
I want
receivable? What
to.
is receivable, and what is revenue? Your basic understanding of what revenue is. They're two different terms, no?
Yes, ma'am.
So, what are these two terms? Are both the terms the same? Are they just synonyms, or they are separate terms? Have their own meaning to it?
Oh, separate terms. Receivable means it is able to be reviewed.
Reviewed of what? The
Received,
amount
received.
received.
Amount,
Okay.
yes. Yes.
Even revenue also you're receiving the amount. Okay, I'll tell you. See, receivable is the amount owed to a seller by a customer.
Okay.
Okay, you're still awaiting that. Why is that? You have a separate department called as accounts receivables. Yeah,
Okay.
you know that your invoice has been created
Yeah,
and
yeah.
you know that you're getting the money. So this is
The
the amount
company will
owed.
receive from its customers who have
Uh,
purchased its goods or
yeah,
services
so
on
this
the
is receivable is the amount owed to a seller by a customer. Okay.
okay.
So whereas revenue is the gross amount recorded. Okay, revenue is the gross amount recorded for the sale of goods or services. Finally, when the collections and everything happens, finally it gets recorded, right? And that
Okay.
is your revenue. How much revenue have you, had this year?
Okay.
If you have a quarterly reports or something, or even monthly reports, so this is the revenue generated for that particular month, okay, of
Okay.
all your goods and services. Suppose if you have three lines of business, so what is all from all the three lines of business, how much revenue you have received, you have achieved, or different line of business, each line of business you will have a report. Okay, this line of, like herbal or pharmaceutical. Herbal, I have had this much of revenue this year. Pharmaceutical, I have this much of had this much of revenue. So this is the difference between both. Okay, you
Okay.
got the difference.
Yes, receivable, it means amount owed to a
Owed,
business
yeah.
regarded as asset. Like,
Correct. Revenue is already which is a recorded, the gross amount
okay.
of whatever
Okay.
the sale that you have done of your goods
Yeah.
or your services. Yeah,
Okay.
right.
Okay.
Okay. So then we have this revenue management work area where this is the area to perform tasks related to revenue recognition and revenue adjustments. Okay, so you run the recognize revenue program to generate revenue distribution records for invoices and credit memos that use invoicing and revenue scheduling rules. Okay, so
Okay.
you perform revenue adjustments on one or more transactions, including scheduling and unscheduling, or reviewing or adding and expiring revenue contingencies and transferring sales credits. So all that revenue recognition happens in your revenue management work area. Okay, from either the billing or receivables balance work area, you have access to manage both customer information and customer account activities, okay, in summary as well as in detail. Okay, so this is your basic three main work areas under your accounts receivables. Okay, then Oracle Fusion Receivables provides a comprehensive solution for running your day-to-day accounts receivables operations. So like Fusion Receivables introduce something called as smart receipts. Okay, what are these smart receipts? This is basically smart receipts is an industry leading automated cash application solution that provide embedded intelligence and focused to do lists of transactions, receipts and other activities requiring immediate attention. Okay, so basically these are, high-end, it's basically a feature provided in the Fusion due to the cloud, feature that the Fusion offers. They have come out with this feature called as smart receipts. Okay,
Okay.
then Fusion Receivables continues to support auto lockbox. Now, what do you mean by auto lockbox? See, auto logbox is a service, okay, that commercial banks, okay, offers corporate customers to enable them
Okay.
to outsource their accounts receivable payment processing. So it is not the company will be doing everything. The bank takes care of it. Okay, so the
Okay.
bank has that lockbox. Okay, so a lockbox operation can process millions of transactions a month. So
Okay.
this auto logbox eliminates manual data entry by automatically processing receipts that are sent directly to your bank. Okay, so once
Okay.
from the this all the entries are done, it will automatically, when the payment is due, that will automatically send a notification to the bank saying that okay, all these payments needs to be received. Okay, and they will be
Okay.
having a contract with those suppliers, like the supplier and company will have a your customers and the company will have a contract, right? So in that they will mention that bank account, okay, this is through this bank that we'll be making transactions and receiving payments and all that. Okay, so that in that we create all these bank accounts in the cash management, so that cash management takes care of all your payments, and then automatically it reconciles your transactions as well. Okay, so this is basically you got the point of logbox.
Yes, ma'am. Yes, ma'am. Yes.
Okay, okay, fine, fine. So you can basically automatically identify the customer who remitted the receipt, and you can use the auto cash rules to determine how to apply the receipts to your customers' outstanding debit items. So for each customer, you can have the define different rules. Okay, so you
Okay.
all that is possible through your lockbox. Okay, all these
Um,
features are available in that. Okay, all right. So then. As I said, okay, smart receipts help in this one, and you have your manual receipt entry, and you can, these are usual, which it's a pretty common in AP also.
AIT
So
also. Yes,
yeah,
ma'am.
yeah, manual receipt entry, and then can load the all the invoices and the receipts via your
Spreadsheet.
spreadsheet.
Yes.
Yeah.
Yes.
So this is how it is. Okay. See, once the concepts, your basic concepts, more or less it's the same thing. Or
Okay.
like APAR is pretty similar. In the payments, you're like making payments, whereas in the receivables you're receiving. That's the basic only difference. I mean, on a larger scale, if you see that's the only difference. Okay. So moving
Mm,
ahead, we have two flex fields in accounts receivables. Okay. The first one is your sales tax location flex field. Okay, so here the sales tax location flex field validates addresses with your home country and calculates sales tax on your shipping address. Okay, where you're actually shipping your items, no, your products. It calculates the
yes.
sales tax of that shipping address. So you must enter a value for this structure in the system regardless of the tax method you're using. Okay, so this is all during the setup we do that. Okay, like now
Okay.
you have GST. So
Yes.
basically you have the same tax running throughout the country, but earlier you had different sales tax percentages in different states had different sales tax rules. So during that time this would really help. Okay, so this also ensures that the location-based taxation will, function properly. You must have values for each customer's addresses in your home country. Okay, so every component of your sales tax location flex field is mandatory when entering addresses in your home country. Okay, this is your
Okay.
sales tax location flex field in your accounts receivable. Next, you
Okay.
have this territory flex field. Now, we use the territory flex field for recording and customizing your reporting on your territory information. Now, territory flex fields are also displayed in the transaction detail and customer detail reports in receivables. Okay, so Oracle Receivables provides a default structure for your territory flex field. You can define up to 20 segments for this structure. Okay, so once you have defined your territory flex field segments, you need to define value sets for these segments. The way we did in the GL, how we
Yes, ma'am.
defined all the flex field, the structure, and then the segments, and then you define the value sets for the segments. Same thing happens here in the AR as well. Okay, and under the territory flex field. So basically
Mm,
you can choose from the following sources as it's given here. Bill to site, you use the customer's bill to address as a default territory flex field. Okay, there is another option of salesman. So you use a territory flex field assigned to your customer's primary salesperson as a default. Okay, and then ship to
okay.
site, this is the customer ship to address as a default. So you can click on any of these options in the drop down when you do a setup. Okay, you can click on
Okay.
any of those three. There are more options also, but these are the main three, which you can click on the territory flex field. So once during the practical session you will understand that what it is. Okay, then
Okay.
moving ahead, we have this receivables accounting event model. So an
Okay.
accounting event is a business event, okay, in Oracle receivables that has accounting impact. Like say for example, creating or applying a receipt is an accounting event.
Okay.
Okay, so not all business events have accounting impact. You getting my point? See, like signing of a contract in a business event does not have
Okay.
have an accounting impact, right? You will not be
Okay.
recording that under your financial statements, right? That you signed a contract, though that's a business event. You're getting that is a business event. Signing a contract is a business event, but that does not have
Okay.
an accounting impact. Like
Okay. Okay.
creating or applying a receipt is an accounting event, but that has an
Yes, ma'am.
accounting impact. Okay, so you got difference in that, right?
Yes, ma'am.
Okay, so so you can modify the accounting setup to create accounting for some events and not for others. Okay, that is possible in your event model. So in Oracle subledger accounting events are categorized into event types. Okay, so these are the event types like create, update, create, reverse update, or create create is this is for adjustments, and for bills receivables you have create and update. Okay,
Okay.
okay, so the
Yes.
overall grouping of these components is called as event model. Like say
Okay.
the event types are grouped into your event classes. Okay, that in turn are grouped into your event entities. So this overall grouping of these components is called an event model. So the Oracle
Okay.
receivables accounting model is predefined by the users and includes each receivables transaction, that is your event class, and its life cycle. So you should understand the receivables accounting event model because the model classifies receivable accounting events, which are the basis for creating subledger accounting. Right? These are your events which are the basis. Only after you create, update, and do reverse and adjustments, that is the basic base of your event model, right? Of your accounts receivables.
Yes,
Okay, so you
ma'am.
need to first understand what all these are. Okay, that is what it.
Okay. Okay.
Okay, so as the foundation of the event model, receivables predefines event entities. Okay, these are the event entities. Now, an event entity enables Oracle Subledger Accounting to handle the accounting for similar business events in a consistent manner. So, the event entity
Okay.
for receivables, are transactions, receipts, adjustments, and your bills receivable. So this figure describes the event classes and types, the receivables, like the event entity and all that. So now under the event class, you have this invoice created, invoice, updated, okay, and
Mm,
reversed and all that. So in the adjustment event entity, you have this create. Okay, you create the adjustments, right? Whereas in bills receivables you create and update, and your miscellaneous receipts you even reverse those updates. So these
okay.
are the events which have been offered by the Oracle receivables, Fusion receivables.
Okay.
Okay, right.
Okay.
So moving ahead, we'll go into auto accounting structure. Okay, 1 second. So, see, what is auto accounting? Auto accounting is a powerful, flexible, and time-saving feature that automatically creates your general ledger accounting flex fields. Okay, so
Okay.
you can set up auto accounting to create accounting flex fields. Okay, these accounting flex fields are your general ledger. Okay, so you
Okay.
remember when I'm telling accounting flex fields is your general ledger, right? So
Mm.
you can actually create accounting flex fields that meets your business needs. So when you run auto accounting, okay,
Okay.
the receivables assigns valid accounting flex fields to your invoices and credit memos. Okay, so this automatically generates a valid accounting flex fields. This is an auto run which happens. Okay, like for
Okay.
your freight, your receivables, your revenue, your auto invoice clearing, you can see this here, right? These are the
Yes.
account types. Okay, and the constant and customer are all the tables. Okay, and these are the table names and the sources from where it actually takes the information for your account types. I'll explain it to you in detail again. I'll be even sharing an example. Okay, okay, so the default accounting that auto accounting creates is considered interim, which is just temporary. The auto accounting which happens is basically temporary. Okay, so your receivables integrates with Oracle subledger accounting, which is the centralized accounting engine which
Okay.
accepts the default accounts that auto accounting derives without any change. So you can
Okay.
modify the accounting rules in your subledger accounting to create accounting that meets your business requirements. So as I said earlier, receivables automatically creates a default accounting flex fields for all these account types like your revenue, freight, receivables, and all that. Okay, auto accounting also creates a proper unearned revenue or unbilled receivable accounting entries, okay, which you need when you use invoicing and accounting rules. I'll be talking about invoicing and accounting rules in the next slide. Okay,
Okay.
so here these two are basically used when the unbilled receivable and unearned revenue is used during your invoicing and accounting, when you are setting up your invoicing and accounting rules.
Okay.
Okay,
Ma'am,
so
REV
yeah,
mentioned as reverse star.
which one?
REV in bracket.
No. This is revenue. REV is revenue. Okay, and REC is receivables.
Receivable. Okay.
Yeah.
Okay.
Okay, I'll explain you about it in detail. So see now, what is auto invoice clearing account is basically your auto in wherein your imported transactions are it automatically gets cleared out. Like, okay, if let's say Oracle receivables uses this auto invoice clearing account to store any differences between the specified revenue amount, okay, and the price times the quantity, especially a suspense account. No, whenever there is a difference in certain
Mm.
amounts, right, it goes and gets sits on it, no, in the suspense account. So
Yes,
this
ma'am. Yes, ma'am.
automatically it gets cleared. So during your
Okay.
reconciliation, you actually go and rectify, you find out, okay, where are these balances coming from, and once those balances are rectified, you close that suspense account. So you can even give that auto invoice clearing option here. Okay, one account. In other words, it's usually you can call it as a suspense account. Okay.
Ma'am, could you please tell me suspense account one time?
See, suspense account is basically where you have your suppose say okay, it's basically a general ledger account, okay, that
Okay.
acts as a holding account, hmm,
Okay.
until the error is discovered or the unknown transaction is identified. Okay, there are some
Oh.
transactions, okay, wherein the amount might not match.
Okay,
The
okay,
receiving, and you would have stated the invoice requisition would have some amount, your invoice would have some amount, and finally you're receiving some amount. There must be some
okay, okay,
differences in all that. So for the time being, what you do is you put all that in your suspense account, and finally when the
okay.
bank reconciliation happens, so all those are checked, all those errors are checked, as in from which source these errors are being created. So you go and rectify those errors, and you finally match your trial balance. Okay, you know the system of trial balance, right?
Yes, ma'am.
Okay, so in the trial balance, you actually check all your errors, then you finally correct it, and then finally that account is closed and removed from your trial balance. So your
Okay,
trial balances have to be equal. Your debits have to be equal to your credits.
okay.
Yeah. So whatever the initially what happens is, whenever the transactions are made, there will be some errors which happens. So all those errors
Hmm.
will go and get stored in your suspense account.
Okay.
Finally,
Then
during
the
your trial
transaction
balance time and your
it
reconciliation
gets
time,
cleared.
yeah, it use actually the accountants actually sit and rectify all those errors. They correct all those errors, and finally that suspense account will be closed in your trial
Okay,
balance.
okay,
Okay.
okay, okay,
Yeah,
okay.
so I got that point. Okay.
Okay.
Okay, so this was auto invoice clearing, and then you have your freight account, which controls the account in your general ledger, to which you post your freight amounts. Your freight is, right, all your transportation charges and
Yes, ma'am.
etc., which are related to that. So in that you can use a constant. Constant is something, a value which doesn't change, so it can always remain constant. Or you can have customer bill to site. These are the table names, as I mentioned earlier. It takes the information from these tables. Okay, the segments that you would have already given, no, in the AR. So it takes the information from these table
In business.
names. Okay,
Okay,
so same as the case with receivables. The receivable account, again, it controls the account in your general ledger, to which you post your receivables amount. Okay, and then
okay,
you have your revenue, the same thing. It controls account in your GL, to which you post all your revenue amounts, right? And the tax amount is the same thing. You post all your tax amount. And unbilled and see, unbilled receivable is wherein your Oracle receivables. See, when I say unbilled receivable and I mention receivables is your module, Oracle receivables, but unbilled receivable is the account. Okay, so don't get confused when you
okay,
should never write it as receivables account. It is like your Oracle receivables is the option or the module. Okay, and unbilled receivable
okay,
is a account, right? So there's a difference of S between that. Okay.
okay,
So Oracle receivables uses the unbilled receivable account for transactions that have invoicing and accounting rules. Okay, it's only for these two, unbilled receivable and unearned revenue, that you'll be giving account invoicing and accounting rules, that I'll explain it to you with the example in the next coming slides. Okay.
okay,
So if your accounting rule recognizes revenue before your invoicing rule bills it, okay, before you bill it, like in bills in arrears is an example for that. Before you bill it and you receive your revenue, before your invoices are being created, receivables
okay.
posts this amount to your unbilled receivable account. Okay, I'll explain it to you in detail. I'll just explain what it means. I'll show it with the example, then you'll be able to relate it in a better way. Okay, then
Hmm.
you can select constant, customer bill, and all these table names, okay, to fill in
Okay,
your values for your unbilled receivable account. Now say if you select standard item here, okay, under the unbilled, okay, the standard item here,
okay,
right? If you select this, the Oracle receivables uses the revenue flex field. That's the reason I've written here, REB is here. It uses the
okay,
revenue flex field that you would specify in the setup. Okay, in the setup
okay,
itself, you will specify all these options there. So now suppose if you select salesperson, suppose if you select sales, you click on yes under the salesperson, you click on salesperson under the unbilled receivable account. Okay, receivables, the Oracle receivables uses a salesperson receivable flex field for this.
Okay.
Okay, so it all depends on how you give, during the setup, which all options you select for.
Okay,
Okay.
madam.
Okay, so
Okay.
these are basically your thing, and then unearned revenue is wherein your receivables, that is your Oracle receivables, uses the unearned revenue account for transactions that have invoicing and accounting rules, as I just mentioned before for the receivable, unbilled receivable account as well. Now, if your
Mm.
accounting rule recognizes revenue after your invoicing rule, bills it, that
Okay.
is your bills
Okay.
in advance. Okay,
Okay.
so the receivable posts this amount to your unearned revenue account. Okay, here
Okay.
if you select a salesperson or a standard item, the revenue flex field, see, both here it is a revenue flex field. Okay,
Mm.
that you specify in your setup will be used. Okay,
Okay.
so this is basically how it is. Okay, now let me just give you an example here. See, 01 you be all in the accounting flex field, we had given named all the segments, no, like the company segment. Okay, this would be, say, your cost center,
Yes, ma'am. Yes.
this would be your account, and this would be a product
Mm.
or anything. Okay, so here
Mm.
what you have done is, with auto accounting you can specify the first segment which is constant. Okay,
Okay.
which is your company segment, which is constant. Okay, and then the second segment is determined by the salesperson.
Okay. Okay.
Okay, so whatever this is what your cost center, right? So that
Mm.
whatever revenue is coming through that particular salesperson, that will all get recorded. So you'll associate that salesperson with this segment. Okay, for
Mm.
your receivables,
Okay.
right? And the third segment is determined by the transaction type.
Okay.
Okay, like the transaction type here.
Type.
And
Okay.
the fourth segment is determined by the product. Okay,
Okay.
now same thing I'll explain it to you in the next example. Okay, so here, now if you want to define a four segment, okay, like company, as I mentioned in the previous example, company, cost center, accountant, product. Okay, now you create defaults for each segment. Okay, the first segment can be constant, okay, which is 01.
Okay.
Okay, you have made a setup like that. This 02 can be anything, or I mean can be a different company. Like, Tata
Okay.
has a lot of companies like Tata Consultancy Service, Tata Motors,
Yes.
right? So but here in this example, we have taken as 01, which is constant. I want to keep it constant. Okay, then
Okay. Okay.
the second segment can come from the salesperson. Okay, John Doe. Okay,
Okay.
okay, so this is, you got it. So this is how your invoice
Yeah.
revenue account will be created.
Okay.
Okay, so this
Okay.
is,
Okay.
you
Okay.
have selected as salesperson, right? And the third segment can come from the transaction type, which is your
Transaction type. Okay.
standard invoice. Okay, which is your
Mm.
third segment, which is account.
Okay.
Then the fourth segment can be from your standard line, which is your 20 megabyte hard disk, which is a product.
Yes. Okay.
Okay, this is a
Okay. Okay.
standard line that, see here, if you see, this is your standard, sorry, this is your standard line in the previous, if you remember, one second, this is your standard line. Okay, standard item, this is a standard line. So this will be your product. So basically you can say the salesperson, John Doe, enters one line standard type invoice for a 20 megabyte hard drive.
Mm.
This is
Okay.
what the invoice description will come as that. So you
Okay.
got how you set up your accounting structure.
Yes, ma'am. I got it.
Okay, okay, fine, good. So basically, your as I said, it automatically creates your accounting flex field, which is a default, and over on top of it, you have to specify that table names. So
Yes,
automatically, the
ma'am.
invoice will get created on that, right? Okay,
Okay.
good. So you got this point. So let's move ahead. The next is accounting rule and invoicing rule.
Oh.
See now, invoicing and accounting rules lets you create, invoices that span several accounting periods. Okay. Like, see, accounting rules determine the number of periods and percentage of total revenue to record in each accounting period. Right? It is a number of
Okay.
periods. Accounting rules determines the number of periods and percentage of total revenue to record in each accounting period. Whereas your invoicing rules determine the accounting period in which the receivable amount is recorded. You're
Okay.
getting my point? It is in the receivable. Now you can make out the
Yes,
difference between
ma'am.
revenue and receivable. Accounting rule is basically the number of periods and the percentage of total revenue to record in that
Okay.
particular accounting period, whereas invoicing rules
Okay.
determine the accounting period both, okay, and in which the receivable amount is recorded.
Okay.
Okay, this is on a larger scale, this is on a smaller scale.
Okay.
You got my point? Yeah.
Yes, ma'am.
So basically, your accounting rules determine the accounting period or periods in which the revenue distributions for an invoice line are recorded. Okay, and whereas invoicing rules determine the accounting period in which the receivable amount is recorded. So you can assign invoicing and accounting rules to transactions that you import into receivables using auto invoice, and to invoices that you create manually in the transaction window. Okay, so you can
Okay.
put these rules, of both, either which you are importing receivables using the auto invoice, or the transactions that you enter manually, right? Okay,
Okay. Okay.
so now we use accounting rules to determine revenue recognition, okay, which schedules for your invoice lines, as I just mentioned. Now you can assign a different accounting rule to each invoice line. All right, not only for the whole distribution line, but for your each invoice line. Right, so
Mm.
accounting rules let you specify the number of periods and even the percentage of the total revenue, as in the definition you can make out, right? So it
Yes.
actually has both. You can specify the number of periods as well as the percentage of total revenue to recognize in each period. So you can also specify whether the accounting rules of of fixed or variable duration. Like, suppose
Okay.
you have a contract of receiving quarterly or monthly or annually sometimes, or maybe on a daily basis. So fixed and variable
Mm.
also, a duration you can fix on that. So accounting rules of fixed duration span a predefined number of periods, and accounting rules of variable duration let you define the number of periods during invoice entry. Okay, so that is your basic accounting rules. And then
Mm.
invoicing rules is something where you as I said, define when to recognize your schedule for invoices that span more than one accounting period. Okay, so you can assign
Okay.
one invoicing rule to invoice, right? You
Mm.
can
Okay.
see there accounting rules, you can assign it to each invoice. Okay, here in
Mm.
invoicing rules, you're assigning one invoicing rule to an invoice. Okay,
Okay.
individual invoice, right? So the invoicing rules determine when to recognize the receivables for invoices that span over multiple accounting periods. So basically there are two types of invoicing rules, okay, which is bills in advance and bills in arrears. Okay, so now just let's
Mm.
understand what each of these means. Now see here,
Okay.
the bills in advance rule is used to recognize the receivables at the time when the bill is raised. Okay, so it is an
Okay.
invoice created before the revenue is recognized. Okay, now say for example, here the company provides services to the client, okay, here, and has entered into a
Mm.
contract for 3 months. Okay, it's a
Okay.
3 month fixed duration, okay, for $3,000 for the months of Jan, February, and March. Now then you should
Okay.
recognize the revenues in that particular month, even though you may have received the payment in advance. Okay, so the invoice raised is a bill in advance, and revenue is recognized in 3 months ahead. Okay, so here
Okay.
you're kind of, see here in Jan, you raise an invoice of $3,000 for 3 month
Mm.
contract. So the accounting rule is 3 months fixed duration. The entry passed would be like in Jan when the invoice is raised, the receivable account is debit, okay, 3,000. Receivable account is debit 3,000 and unearned revenue credit 3,000. You
3,000.
got the term unearned revenue here. Yeah,
Yes,
3,000.
ma'am.
Okay. Then you receive a payment of 1,000 as a contract
Hmm.
is, okay, bills, they will, have the whole payment done in 3 months. So then you receive a payment of $1,000. So the entry gets reversed, right? So the unearned, where's my mouse? Yeah. So the unearned revenue debit $1,000 and revenue account credit $1,000. Okay.
$1,000.
Yeah. So this gets reversed. So now the whole remaining
Okay.
2,000 is theirs, right? So that will again get reversed in
Yeah,
the
2,000 will again in February and March.
correct. So same way in February when the invoice is raised, it gets cleared. The entry is unearned revenue as a entry. We have to reverse it, right? For the we have to
Yes,
balance
ma'am.
out the 3,000 rupees, right? So the entry
3,000.
again,
Yes, yes.
yeah, gets reversed to unearned revenue debit $1,000, then revenue account credit $1,000. Same thing for the month of March, unearned revenue debit 1,000 and revenue account credit $1,000. So this is how your
No.
bills in advance accounting, invoicing rule and accounting rule. See here it's mentioned, right? Invoicing rule is bills in advance, whereas accounting rule
Yes,
is 3-month fixed duration.
okay.
So now you got the point of how invoices with accounting rules
Yes, ma'am.
work. Okay, next is the
Yes.
example with bills in arrears.
Okay.
Okay, so here you use the bills in advance. Okay, sorry, bills in arrears rule. If you
Arrears.
want, yeah, bills in arrears rule, if you want to record the receivables at the end of the revenue recognition schedule. Okay, here in the example for the invoice, again, same thing, $3,000 raised for a 3-month contract. Okay, the accounting entries
Okay.
would be, this is passed like this. Here in January, when the invoice is raised, the unbilled receivable, okay, debit is 1,000 and the revenue
Revenue.
account is 1,000 credit, revenue account credit is $1,000. Okay, then in
Okay.
your February, when the invoice is raised, the unbilled receivable debit is $1,000 and the revenue credit is $1,000. Then finally in the month of March, when the invoice is raised, the unbilled receivable debit is 1,000, then the revenue account credit is 1,000. So the receivable debit $3,000 and unbilled receivable credit is 3,000. So this is the month where you finally, raise your what do you say, your bills, I mean your invoices, and finally the amount gets cleared. Okay, you're
Okay.
raising the bills in arrears. I mean you have a contract here and finally this amount gets realized. You got
Mm-hmm.
this,
Okay.
you bills in
Yes.
arrears.
Yes.
Okay, fine. Right, we still have time, right? Okay, because
Yes.
I'm just left with one last topic. And okay, fine. So you clear with your invoicing rules and accounting rules, right? You're clear with that.
Yes, ma'am. Yes,
Okay,
ma'am.
good. Fine. Okay, now we have something called as statement cycles. See, you define statement cycles to determine when to send statements to your customers. Okay, so you assign statement cycles to customer and site level profiles. So basically, if you want to print statements for a specific customer, then you would have defined a statement site for the customer. Okay, so Oracle Fusion
Okay.
Receivables uses the statement cycle defined in the customer account profile as a default statement cycle to use for printing. Okay, suppose if
Mm-hmm.
you
Okay.
have not defined a statement site, then the receivables uses the statement cycle defined in the customer site profile for each applicable bill to site, okay, included in the print
Okay.
run. Okay, so these are all the setups that we'll be doing. Okay, and then if you do not select a customer, say for example, then what will happen? The receivables prints a statement for all customers that have a statement cycle that matches the statement cycle you enter for the print run, right? You got the point.
Yes,
If
yes.
you have not
Yes,
specified a
ma'am.
select customer, then whatever during this select cycle, you would have entered some details, right? So whatever customers statement cycle are matching with that, it will start, printing all those statements at the same time. So, but when you
Yes,
create
ma'am.
a statement cycle, you define the interval to be used to the cycle. So, like say interval like
Okay.
your weekly, monthly, or quarterly, okay, and the dates on which
Okay.
to print the statements for the cycle. And you can also
Hmm.
indicate if receivables should skip certain statement dates. Okay, those changes also you can make it. Okay, then the
Okay.
receivables includes all activities from the last time you printed a statement for this customer to the current statement date, even if the customer statement cycle is set up to skip. Okay, skip printing on one or more statement dates. I'll show you, I'll explain to you in the examples. It is just like your bank statement, Durai. Okay, every time,
Yes, okay.
whatever happens, everything gets recorded, right? The same thing is, we can relate that with the statement cycles that is being printed, okay, for accounts receivables. Now, in this scenario, you have a system date 3rd September 2020, and your statement date
Okay.
is 1st September 2020. Your previous
Okay.
statement date, okay, which was supposed to be printed, but you have clicked on the skipped one, okay, like 1st June 20, which has been skipped, and your statement cycle is quarterly. Okay, so this is the scenario which has been given here. So what all
Hmm.
activities are included in this statement, right? See, the activity included in this
Hmm.
statement spans the date the statement was last printed. Okay, it starts from here, from 1st March 20, the statement
First
last
month.
printed, to the current date of September 1st, 2020. Okay, and the
Okay.
previous system dated 1st June 20 has been skipped. So the activity for that period now shows on the current statement, but still it will be printed because it is between those statement, right? So still this will be
Yes.
showed as previous statement date skipped for that particular statement. So but this table
Okay.
illustrates even the logic used, okay, to particular invoices on that statement. There will be more invoices also which will be raised. Now suppose there is a invoice which has been created on 28th Feb 2020. Will it be included in the statement? No, it will not be included unless it is either still open or was closed between 1st March 2020. Okay, I think I've typed it wrong. Fine. 2020 and 31st August 2020. Okay. So
Okay.
even only if the period was open, then it will show, then it will be included in the statement. But otherwise, on a general scenario, it will not. This particular invoice which was created on this particular date will not show in the statement. So what about the
Okay.
invoice which was created on 30th August? Yes, this will be shown because the invoice date is between the date of the statement which was printed at the previously and the statement date. The statement date is 3rd September, right? And the one which was printed
Hmm.
earlier was 1st March. And the 30th August falls in between. So this,
Yes,
invoice
ma'am.
also will be shown in the statement. And what about the
Okay.
invoice date, which is will be created on 2nd September? This also will not be included in the statement because the invoice date is later than the statement date.
Statement date. Okay.
Yeah, 1st June is 1st September is till what we have selected, right, for the statement cycle.
Yes,
So the
ma'am.
2nd September will not be shown. Right, Durai? So this is
Okay.
basically
Yes.
the main, core concepts of how your receivables work, and the rest and all will be showing it to you in the practicals, like how all these setup is done, okay, in the instance.
Hmm.
Right,
Yes.
Durai? So any doubts
Okay.
in this? I think mostly it's pretty,
Hmm.
I mean, understandable, right? It is not that difficult
Yes,
as
ma'am.
GL, huh? Yeah. So
Yeah.
even
Yeah. Yeah.
AR setup also is pretty easy, not that difficult. Once we finish off the AP, the AR also we can, not much of setup is there in that. Just very few steps
Okay.
to be done. Okay. Fine, Durai. So tomorrow I'll take cash management. Okay. We go through
Okay.
this once. In case if you have any doubts, you just let me know. Can let me know tomorrow. Okay.
Okay, ma'am.
Yeah, oh,
Okay.
just because just 1 second, I'll just stop recording. 1 second.